Well, every Tuesday here in our office, we are very fortunate to get the professional update from our in-house mortgage advisor. And at Michael Saunders, we are a full-service firm. We have a mortgage company, insurance, we have our own title firm. And so on Tuesdays, we get our Mortgage Minute update from our in-house mortgage expert, Matt, who is joining me here today. So if this is something of interest to you, please stick around for all the details. Hi, I'm JJ with Michael Saunders Company, and on this channel, Living in Lakewood Ranch, we talk about all things Lakewood Ranch and the surrounding areas. And today, specifically, I want to talk about the financial aspect of buying a house. And I'm bringing in our mortgage expert, Matt Lambert. Thank you for joining me, Matt, today.
Thank you very much for having me.
We are so fortunate. He is able to explain what is constantly changing in the mortgage market, and right now is a big pivoting change. So before we start talking about what's going on in the market, Matt, you and I met several years ago. The first time I met you, actually, you were handling my personal mortgage.
Yes, indeed.
And you were just, you know, even as a real estate professional, I had so many questions and all of this going on, and I just felt like I was in great hands with you. So thank you again.
Well, thank you very much. Always appreciate it.
And we had a successful
Years
outcome.
on, I still appreciate hearing it.
So, but tell me a little bit about your background in the mortgage industry.
Sure. So I've been in the mortgage industry now for about 11 years, all with MSC Mortgage. I moved down this way, live in the area now, and had you asked me when I first came out of school or was finding the job path in life, whether or not I would be doing mortgages, I would have probably laughed. It just was not what I had anticipated doing. But there was some familial ties into the industry. I started to follow them. And then I realized that the job here is so much more than just crunching numbers. It's so much more than running a calculator. There's a lot of personal skills with it. There's a lot of just really interwoven connections with our buyers that I realized that's what I actually have a passion for. And it's not sales, it's not the numbers, it's none of that. It's the actual ability to work with people that has really kind of transcended why the job has lasted the way it's lasted for 11 plus years.
Yeah, you are truly a partner on that journey to the home purchase.
Oh, absolutely.
Yeah.
I look at it from step one across the board, whether it's the pre-approval and pre-qualification, before people even find a house, that, hey, listen, we're going to work through all of what needs to happen here, from what can we afford to how are we going to be able to make it work. And then once we go to contract, how do we get you to the finish line? That's exciting stuff. Right?
Yeah.
This is usually the biggest purchase that people make in their life. Mm-hmm. And because of that, that's where I feel a sense of pride when someone gets to a closing table, because I've been able to help them realize a dream. And whether it's first-time home buyers or people who are retiring, that's cool to do.
Yeah, and working with you day to day, I've seen this, and we work as a team, and yeah, you are gifted in that.
Well, thank you very much.
Realm with the unexpected.
Thank you. Yeah.
Matt's got this.
The world is unexpected. Mortgages are no different. So
yeah. So I am feeling very optimistic. All of what I'm hearing about the economic forces that influence the mortgage rates seem to be coming together, and there is an expected, long-awaited interest rate reduction expected at the next Fed meeting. And so this is your arena, and you explain it so well at the meetings. Can you kind of catch us up where we are now, and
Sure.
what is bringing us to this expected interest rate drop?
So right now we're seeing the big headline news is that the Fed is going to anticipate cutting rates at their next meeting in September. Now, we've heard this before. These were the headlines that we expected at the beginning of the year. And really what drives the Fed are what generally comes across as three very large economic indicators. There's the manufacturing data, which is how much stuff is being made. There's the jobs and employment numbers, which is basically what jobs we have and how are we paying for this stuff. And then there's the inflation data that says how much are we willing to pay for this stuff. Mm-hmm. And so those three key components are what the Fed is ultimately looking for to see how strong is the economy behaving. Because if we all have jobs and we're all buying stuff, then the idea of softening rates and softening the costs of things doesn't tend to be their driver, right? So they are going to look at it from the perspective of saying, all right, well, if that's the case, then the economy's doing well for things right now.
Things are good.
Things are good. Why do we need to soften it? However, what we've started to see over the last 6, 8, 12 months is we've started to see inflation come down. We've started to see unemployment go up. We've seen manufacturing data start to move in a direction where we're not buying as much. You're seeing changes in what buyers are looking at and how they're spending their money, and that's what the Fed has to kind of keep in mind when they start to look at changing the federal funds rate. Now, I think it's really important to note that the federal funds rate and interest rates that you see on a mortgage are two very different figures.
This is always confusing to me, even though you keep telling me this. But go ahead, tell us again.
They're two very different lines. So your interest rate that you see when you talk to a mortgage professional is essentially the rates that are out there in the market right now, and that's how we calculate what a monthly payment's going to be. The federal funds rate, in very easy layman's terms, is how much does it cost for banks to exchange money with one another. So when we hear this headline that the Fed is looking to cut the interest rate, they're looking to cut the federal funds rate in September, what they're looking to do is cut that number, that is, how much does it cost for banks to exchange money. It does not mean that interest rates are going to move immediately on that day with regards to a mortgage. It's very ankle bone is connected to the hip bone. Now, if a bank doesn't have to pay as much to exchange their money, then in fact, in turn, we can see rates or expect to see interest rates come down. Think of it like eggs, right? If the cost of an egg goes down, eventually the cost of the cake is going to come down. However, it doesn't mean that it's going to happen immediately. It's not going to happen overnight. So we're going to see that transition and that move forward, but it's not going to be an immediate movement on your interest rate when they decide to cut it 25 or 50 basis points. It doesn't mean that our rates are going to move that much in one day.
Yeah. You know, it is so interesting that I've seen, it was just over 2 years ago that we had a sudden increase in the interest rates, and it affected our local market. And now I can see that this anticipated rate decrease that's coming up is positively affecting our market. But we in the Lakewood Ranch and Sarasota areas are very cash driven. We're probably, averaging around 68% cash purchases. And it's always a little bit of a mystery. Why does the interest rates so severely impact a cash-driven market like we are?
Sure, and I think there's a lot of factors that go into that. And it comes into play from the portfolios that the buyers have, whether they're accessing those funds or whether it's they're selling their properties in a different market and transitioning here. We work with a lot of different buyers who are, even if they're entering into cash contracts, who still explore the idea of financing, whether it's only a couple $100,000 or it's just enough to get them to the finish line. There's a lot of conversations that we have with buyers and financial advisors where we try to find perhaps maybe the middle ground of what the best use of their funds are. So I think when you start to see that interest rates have really, really climbed up, you may not see their markets moving in the same direction. Their portfolios might not be moving in that same manner. And the idea of, do I want to pull all of my funds out? I'm trying to transition down here and I don't want to have to access everything that was my nest egg. I don't want to put that all into my property right away. Those have heavy impacts, and even with the cash market, as far as what we can see as far as buyers go.
One point of interest that you mentioned at this morning's meeting is our national average interest rate, and I'm assuming this was for a 30-year fixed, is 6.5%. And that's a downward trend, a recent downward trend. And the Fed hasn't even met yet. Can you explain how come we're already seeing a trend downward?
Absolutely. Well, it lies in anticipation. It's the markets and from the side of a bank starting to anticipate what's coming down the line. And so you'll actually, most likely start to see downward movement in interest rates even ahead of this Fed meeting. It's where we've come from over the last probably 2 months, 3 months maybe actually, of positive from the world of mortgage. It sounds very counterintuitive. Positive news, meaning inflation's coming down, that's a good thing, but unemployment has started to rise. It's at 4.3% on a national. That's bigger than the projected number that they had anticipated at 4.1, 4.2. Those were the numbers where they had thought it would finish the year at. We're at 4.3 and it's July. So those types of reports that come in on a monthly basis really start to move from the perspective of a bank what they anticipate to see the rest of the markets following. So whether, and there's a lot of factors, and banks don't just look at the Fed rate. They look at the 10-year Treasury. They look at the 30-year mortgage-backed security market. There's a lot of different factors that they look at, and those will move with all kinds of different information. Whether it was the Japanese markets 2 weeks ago, or any of the other data that comes out, there's so many forces that come into play that the Fed is only really one part of that. And that's part of why we're seeing rates already start trending downwards, because we're reading the reports, we're reading the market data that's being compiled and provided that the Fed will ultimately decide upon. But we're reading it a bit ahead of time saying, okay, this is where we anticipate. Now, when you see markets move up and down, or interest rates move up and down, it's because most likely we've anticipated one thing and then something has changed and moved in a different direction. And we all of a sudden have to recoil a little bit, we rebound, and that's how then we say, oh, well, rates moved up and down during the day or during a week or even over a 3 to 6 month window.
I do have one more question for you that I think will be very valuable to our viewers. At what point should somebody call you and say, hey, Matt, I'm thinking about moving to Florida. I live in Virginia now. And at what point is that initial phone call typically, and what do you recommend? Well, and what does that look like? What does that conversation look like?
The easiest answer is the sooner the better. and I mean that from a whole lot of different fronts. The sooner the better. And the reason for that is that we can work through on our side all of the pre-qualification and pre-approvals through a lot of hypotheticals. Oh, I'm selling my home up north. Oh, I'm going to have, this is what my new picture is going to look like moving forward. I'm retiring. I'm going to, whatever the case may be. And the sooner that we know that, the better, because then we start to eliminate a lot of the unforeseens, the obstacles, the hurdles that generally fall into the process. Those are where buyers get really frustrated with getting a mortgage. I get it. Getting a mortgage is oftentimes described as worse than getting your teeth pulled, and it's really no fun. My job is to try to make it a whole lot less than that and try to make it actually something. And so the sooner that we can get out in front of the changes that may be happening, even if there are very limited changes. Oh, I'm buying a second home. I'm buying this as an investment property. Well, then we can start to dialogue on, well, what are the down payment requirements? What can you expect for an interest rate? What can we expect as far as how much paperwork am I really going to need to go through? It's a lot. It's a lot, all right? But the sooner that we can get out in front of that, the better it is for a buyer, because they have an understanding of what they can realistically purchase. And sometimes that's more than they thought. Sometimes it's less than they thought. It starts to put into perspective the amount of money they're going to have to actually come to the table with. And then it really helps start to put into a contract timeline of saying, we're going to write an offer. I am now this much further down the road, and I can actually write a contract with a defined closing date and be more aggressive on that front and actually be able to close, rather than coming into it, writing an offer going, sure hope this works. Yeah. That's the last thing we want.
And I just can speak from personal experience where there was a significant obstacle that came up in my mortgage process, and fortunately I did have the time, and we worked as a team to strategize successfully to get to the table. Luckily we had the time to do that. So I support your answer.
Well, appreciate it. Time is a necessity.
The sooner the better. I probably should have come sooner to you myself. So Matt, I know you get this, people want you to look into your crystal ball.
Always.
Always. But you do come with a lot of knowledge and experience. So if the Fed does say reduce the interest rate by 25 basis points or 50 basis points at their meeting in the fall, what does that look like for us as consumers as we approach the end of the year?
Well, you're correct. There is no crystal ball to it. However, from those who get paid to do the projections and those who look into their own crystal balls and see where things are going, the general thought is that we should expect to see rates start to move below 6 and into the 5s. That would be a really strong case scenario towards the end of the year. If we get that, I think that would be a big win. Now, obviously, this is one of those cautionary tales because we started the year with the idea that these rate cuts were going to start in May. And we got and put that cart out in front of the horse, and the horse never caught up. And here we are doing it again in September, and yeah, we're projecting that this is going to happen. So I think it's best to take it all with a grain of salt. Yeah. But the anticipation is to see rates start to move below 6 into the 5s. It's going to be a longer process than I think a lot of people ever predicted, as we're seeing now with the fact that this has moved to September before we've even seen a rate cut. So I wouldn't expect it to be an immediate. It's certainly not going to be a very quick knee-jerk reaction seeing rates fall right away. Yeah. I've often described this as landing an airplane. This is not landing a helicopter. We are going to glide into lower rates. We are not going to come straight down to them. But I think that the big picture says that ultimately rates in the 5s is going to be the big win, and that's going to be where we're going to start seeing a lot of movement. It's where we're going to expect to hear and see more movement from customers is as we get into that position. But I would caution the idea of waiting. Yeah, I really would. I would caution the idea of waiting on a couple of fronts. We've certainly seen that when rates do go down, competition goes up.
Correct. Yeah.
We see that when rates come down, buyers who've been sitting on the sidelines and waiting for a certain rate to make them move, that will suddenly start to increase competition. And if it increases competition, then that suddenly starts to change how do buyers make offers, what are sellers looking at, etc.
Yeah, I see that also. And I think, it is a good point that we were anticipating this earlier significant rate change, which didn't happen, and it did leave a lot of buyers that are anxiously waiting, and it is going to bring a lot of competition to the table.
Pent-up demand is going to be there. If we've had people who've been thinking that the rates were going to drop since the beginning of the year, which was the projection. The Fed revised their own projections mid-year. So they've revised things. We have pent-up demand with those who've been waiting for this to come. As soon as it starts to move, I could see things really start to turn in the fashion of getting competitive again.
Yeah. All right. Well, we did cover a lot, more than we do in our meeting, but we're very fortunate you do it every week in our meetings. So we come in already with some information from the previous week. But Matt, thank you.
Thank you very much for having me.
This was very complicated, but you made it very clear, and that's one of the things that I really appreciate about you. So thank you for joining us today.
Thank you very much for having me. It's been an absolute pleasure.
Well, I was really excited to be able to introduce my colleague, Matt Lambert, to you with his incredible knowledge of the mortgage arena. He's a great resource, so I'm going to put a link in the description below so you can reach out to Matt directly. You'll have your own specific situation that you'll want to talk about with him, so I'm so happy to be able to offer him as a resource to you. And if you are thinking about coming to the area, I'm going to also put a link in the description below. I would love to connect with you, work with you, and help you with that wonderful process of moving here to Lakewood Ranch. Thank you so much for joining me today. JJ, Michael Saunders Company.